Welcome, financial trailblazers. Are you ready to go on an exciting journey through the fascinating history and evolution of the stock market? Buckle up because we're about to delve into the beating heart of the global economy. Now, why should you care about the stock market? Picture the stock market as the engine that fuels the economic machine. It is a dynamic marketplace where businesses and investors come together in a whirlwind of financial possibilities. The stock market is not just a numbers game. It's a powerhouse that drives economic growth, shapes industries, and offers a slice of prosperity to those who dare to navigate its intricate landscape. But enough with the formalities. Today, we're diving headfirst into the riveting saga of the stock market's journey. From its humble beginnings to the awe-inspiring global force we know today. Get ready for a sneak peek into the exciting topics we'll delve into in today's video. We're kicking things off by rewinding the clock to the roots of stock trading, where it all began. Imagine the cobbled streets of 17th century Amsterdam, where traders gathered to exchange not just goods, but also groundbreaking financial instruments. This was the birthplace of the world's first official stock exchange, laying the foundation for what would become a global economic epicenter. Fast forward to the bustling streets of London in the 1800s, and the birth of the London Stock Exchange. Explore with us as we witness the beginning of the New York Stock Exchange, shaping the modern stock market as we know it. Hold on to your seats as we jet set across continents to witness the global expansion of stock markets. From Asia's economic rise to the emergence of stock exchanges in Latin America and Africa, the stock market has become a powerful force, shaping the destiny of nations and influencing the course of history. The Industrial Revolution adds fuel to the fire, propelling stock markets to new heights and intertwining economies on a global scale. But, it wasn't all smooth sailing. Join us in exploring the challenges, triumphs, and sheer resilience of the stock market through world wars, economic downturns, and financial crises. Spoiler alert, it always bounces back, stronger and more resilient than ever. In this part, let's zoom into the future with a riveting exploration of technological advancements that have transformed the stock market landscape. From the advent of electronic trading to the rise of algorithmic marvels, these innovations have revolutionized how we engage with stocks. Get ready to unpack the digital revolution that's reshaping the way we trade and invest. Ready to fast track to the present? In this segment, we're discussing the latest developments and trends that are currently reshaping the stock market. From the globalization of stock markets to the influence of cutting-edge financial regulations, we're dissecting the ever-evolving face of the stock market in the 21st century. Buckle up as we navigate the currents of change and uncover the strategies driving success in today's dynamic financial landscape. As we wrap up this whirlwind tour, you'll have gained a newfound appreciation for the stock market's pivotal role in shaping the world. But hey, we've only scratched the surface. This is just the beginning of our adventure into the intricate web of stocks, bonds, and economic dynamics. So, grab your popcorn, get comfortable, and let's explore the captivating history and evolution of the stock market together. Don't forget to hit that subscribe button, because trust me, you won't want to miss what's coming next. Now, we're stepping back in time to explore the fascinating early origins of the stock market. Fasten your seatbelts as we journey through the 1600s in Amsterdam, witnessing the birth of stock trading and the foundations of global financial markets. Our first stop takes us to 1602 in Amsterdam. The Netherlands has been characterized as the first modern economy in the world. And for good reason. In the early 17th century, essential components of today's Western economic model emerged in the Netherlands. This is also true of stock trading. Both the stock market and the related idea of financing companies through the stock market are 17th century Dutch discoveries. The leading role in Dutch stock exchange history belongs to the Verenigde Oost-Indische Compagnie, VOC. It was the first company to go public in 1602 and thus founded the first stock exchange, the Amsterdam Stock Exchange. The initial public offering is not an isolated event. It was preceded by a significant other innovation, the invention of the modern company, the limited liability company, by that same author. As the birthplace of the world's first official stock exchange. This era laid the groundwork for the dynamic markets we know today. Our journey continues with the emergence of the East India Company. A monumental force that played a pivotal role in the evolution of public trading. As maritime adventures unfolded, so did the concept of publicly traded companies. The emergence of the East India Company marked a groundbreaking chapter in the history of the stock market during the 17th century. Founded in 1600, the company became a pivotal player in global trade, establishing a vast network connecting the East Indies with Europe. To fund these extensive ventures, the East India Company turned to public trading, offering shares to investors. This move marked a revolutionary shift, introducing the concept of publicly traded companies and laying the foundation for the modern stock market. As public trading gained momentum, it not only provided investors with an opportunity to participate in global trade, but also contributed significantly to the growth and development of stock exchanges worldwide. Explore with me how this revolutionary development marked a turning point in the relationship between commerce and investment, setting the stage for the global markets we engage with today. Venturing further into the historical tapestry, we arrive at a period of significant expansion, the introduction of stock exchanges in Europe. As the success of Amsterdam's exchange became apparent, other European cities followed suit. London emerged as a financial powerhouse, with the formation of the London Stock Exchange in 1801, solidifying its status as a global financial center. This spread of stock exchanges across Europe marked a transformative era, enhancing liquidity, facilitating investment, and contributing to the interconnectedness of the world's financial markets. The establishment of these exchanges laid the groundwork for the dynamic and complex global financial system we navigate today. From London's bustling streets to the vibrant financial hubs across the continent, witness the transformation of stock trading from localized markets to interconnected exchanges. It's a tale of innovation, risk-taking, and the birth of a truly global financial ecosystem. As we conclude our early origins time-traveling expedition, we've witnessed the birth of stock trading in Amsterdam. the influence of the Dutch East India Company, and the spread of stock exchanges across Europe. These chapters not only shape the past but lay the groundwork for the dynamic and interconnected global markets we navigate today. Stay with me in the next installment as we unravel more chapters in the captivating story of the stock market's evolution. The birth of modern stock markets. Let's dive into the early 19th century, a pivotal time in financial history. London, already a bustling center of commerce, found itself in need of a more organized and regulated marketplace for stocks. The demand for a centralized trading system became evident as merchants and investors sought a formalized platform. Enter the London Stock Exchange in 1801, an institution born out of this pressing necessity. The exchange's initial days were humble, operating as a coffeehouse where traders gathered. However, as demand soared, it outgrew its informal origins, moving to a more structured setting in Capel Court. This marked a significant shift, signaling the transition from an ad hoc gathering place. The early years were characterized by rapid evolution and a commitment to creating a more organized marketplace. The establishment of the London Stock Exchange had profound implications beyond the city limits. London quickly transformed into a financial powerhouse, attracting investors and businesses from around the globe. The exchange played a pivotal role in facilitating the growth of industries, encouraging investment, and influencing the economic trajectory of not just London, but the entire United Kingdom. As we explore further, it's essential to understand the market dynamics that shaped the early London Stock Exchange. Brokers and investors adopted formalized trading practices, bringing a level of structure and regulation previously unseen. The emergence of standardized contracts and the introduction of official listing requirements set the stage for a more transparent and efficient marketplace. The legacy of the London Stock Exchange endures, reflecting its historical significance. Its formation marked a milestone in the evolution of financial markets. The exchange's continued adaptation to changing financial landscapes showcases its resilience and relevance, cementing its place as a symbol of financial innovation and global connectivity. The New York Stock Exchange, NYSE, and its early years. In the bustling streets of New York City during the late 18th century, the seeds of what would become the New York Stock Exchange were sown. Established in 1792 under the Buttonwood Agreement, a group of 24 stockbrokers and merchants gathered under a buttonwood tree on Wall Street. This agreement laid the foundation for organized securities trading, creating an environment conducive to formalized exchanges. As the NYSE took root, it underwent a transformative phase in the early 19th century. The introduction of telegraph communications in the mid-1800s revolutionized the trading floor, enabling faster and more efficient dissemination of information. This shift in communication marked a crucial step towards the modernization of trading practices, setting the NYSE on a trajectory to becoming a global financial powerhouse. The Industrial Revolution brought about significant changes not only to the economy but also to the NYSE. The influx of industrial companies onto the exchange spurred unprecedented growth. Railroads, steel, and other industries fueled economic expansion, and the NYSE became the epicenter for trading the stocks of these burgeoning enterprises. This era marked the NYSE's evolution into a key player in the global financial landscape. As the 19th century drew to a close, the NYSE solidified its position as a leading global exchange. The expansion of telecommunication networks allowed the exchange to reach a wider audience, attracting international investors. The NYSE's influence transcended national borders, and by the early 20th century, it had become synonymous with the heart of financial activity. Despite facing challenges such as the Great Depression in the 1930s, the NYSE demonstrated remarkable resilience. The implementation of trading curbs and other regulatory measures aimed at stabilizing the markets showcased the exchange's commitment to adapting to the ever-changing financial landscape. This period marked a testament to the NYSE's ability to weather storms and emerge stronger. The Industrial Revolution, which gained momentum in the late 18th century, was a catalyst for profound changes in stock markets. The shift from agrarian economies to industrialized societies brought about a surge in new businesses, particularly in the manufacturing and transportation sectors. This surge created a need for capital, prompting companies to seek funding beyond traditional methods. With a rise of industrialization, an increasing number of companies sought to raise capital by offering shares to the public. This led to the expansion of stock listings on exchanges, providing investors with an array of opportunities. The dynamism of industrial growth transformed stock markets into hubs where investors could participate in the economic revolutions unfolding across various sectors. The impact of the Industrial Revolution rippled beyond national borders, connecting economies on a global scale. The growth of international trade and the expansion of industrial enterprises transcended geographical constraints, fostering a new era of economic interconnectedness. Stock markets evolved into platforms where investors could engage not only in local businesses but also in enterprises with global reach. The Industrial Revolution fundamentally altered market dynamics. Traditional sectors such as agriculture took a backseat to burgeoning industries like railroads, textiles, and steel. This shift in economic focus prompted investors to realign their portfolios, emphasizing the stocks of companies driving industrial progress. Stock markets, in turn, adapted to accommodate these changes, with exchanges witnessing increased activity in shares related to industrial enterprises. As industries flourished, the economic landscape expanded, driving technological advancements. Innovations in communication and transportation, such as the telegraph, played pivotal roles in shaping the evolution of stock markets. These technological leaps transformed the nature of trading, enabling faster and more efficient transactions. While the Industrial Revolution fueled economic growth, it also presented challenges. Market volatility, financial panics, and speculative bubbles were inherent risks. The evolution of regulatory measures aimed at addressing these challenges showcased the resilience of stock markets. The stock market became not just a reflection of industrial progress but also a driving force behind technological innovation. As we step into the 20th century, let's delve into the fascinating evolution of stock markets in Asia. The 1900s witnessed the rise of economic powerhouses such as Japan, India, and China. In India, the Bombay Stock Exchange, BSE, was established in 1875. BSE emerged as a key player, fostering investment and capital flow. The exchange operated under a banyan tree in front of the town hall in Bombay, now Mumbai, where Hanuman Circle is now situated. It was later on moved to the current location of Dalal Street. Japan's Tokyo Stock Exchange, established in 1878, played a pivotal role in the country's economic growth. It initially operated under a ginkgo tree in Nihonbashi, Tokyo. This historical detail highlights the humble beginnings of the exchange before it evolved into one of the largest and most advanced securities markets globally. Hong Kong Stock Exchange was established in 1891. One special feature when it was established was its role as a platform for trading tea shares, reflecting its roots as a market for commodities, especially tea companies. Inception of share trading in Sri Lanka under the Colombo Share Brokers Association (CSBA) in 1896 marked the beginning of organized share trading in the country. The Philippine Stock Exchange was founded in 1927. It has weathered significant historical events, including the Japanese occupation during World War II and the martial law period in the Philippines. The Dhaka Stock Exchange, DSE, was first established as the East Pakistan Stock Exchange Association in 1954, reflecting its origins. Following its independence in 1971, Bangladesh renamed it DSE. Taiwan Stock Exchange was established in 1961. It started as the Taiwan Securities Exchange and operated as an informal over-the-counter (OTC) market until it officially became the TWSE. Malaysia's Bursa Malaysia was founded in 1964, followed by its derivatives exchange in 1980 and Mestak in 1997. In 1967, Iran's Tehran Stock Exchange was founded. In 1975, the Stock Exchange of Thailand was established. The Bahrain Stock Exchange was established in 1987. Shanghai Stock Exchange was founded in 1990. It was the first stock exchange to be reopened in mainland China after a hiatus of several decades. In 1992, India's NSE was founded. In 1993, Royal Securities Exchange of Bhutan and Nepal's Stock Exchange was established. In 1995, Palestine Securities Exchange. And in 1997, Qatar's Doha Securities Market were established. Indonesia Stock Exchange, as well as the Singapore Exchange, was founded in 1999. Also, Jordan's Amman Stock Exchange in the same year. China's economic reforms in the late 20th century laid the groundwork for the development of its stock exchanges, showcasing Asia's significant contribution to the global financial landscape. So many other countries followed suit and opened their stock exchanges in the upcoming years. Focusing on Central Asia, the Kazakhstan Stock Exchange was founded in 1993. This was followed by the Kyrgyz Stock Exchange. State Commodity and Raw Material Exchange of Turkmenistan, and Tashkent Stock Exchange in 1994. Moving on to Eastern Asia, the Mongolian Stock Exchange was founded in 1991, and the South Korea's Kosdaq in 1996. In Northern Asia, the Russian Moscow Exchange, MOEX, was merged in 2011. In Western Asia, UAE's Abu Dhabi Securities Market and Dubai Financial Market in 2000. It was followed by Iraq Stock Exchange was established in 2004. Then came Saudi Arabia's Tadawul in 2007. And Syria's Damascus Securities Exchange in 2009. In Southeast Asia, Cambodia Securities Exchange and Laos Securities Exchange was founded in 2011. Malaysia's Fusang Exchange was founded in 2015. Also, Vietnam's Ho Chi Minh Stock Exchange was established in 2000, followed by the Hanoi Stock Exchange in 2005, and the Vietnam Stock Exchange in 2021. Moving down south, We have the Maldives Stock Exchange, founded in 2002. Afghanistan Stock Exchange, founded in 2009. The Pakistan Stock Exchange, established in 2016. So many countries now have their own stock exchanges, and some countries have multiple exchanges. Turning our attention to Latin America, the biome of Argentina was founded in 1854. The B3 Stock Exchange of Brazil was established in 1890. It was followed by the establishment of Chile's SSE in 1893. And Mexico's BMV Stock Exchange in 1894. The 20th century marked a period of substantial growth for stock exchanges in the region. Exchanges in Brazil, Mexico, and Argentina became vital components of their respective economies. Exchanges in Brazil, Mexico, and Argentina became vital components of their respective economies. The interconnectedness of these exchanges with global markets highlighted Latin America's emergence as a key player in the world economy. As we venture into the African continent, the role of stock markets in shaping economic development becomes evident. The Egyptian Exchange, EGX, founded in 1883, is the oldest stock exchange in Africa. There are 29 exchanges in Africa, representing 38 nations' capital markets. 21 of the 29 stock exchanges in Africa are members of the African Securities Exchanges Association, ASEA. Exchanges in South Africa, Nigeria, and Kenya played instrumental roles in mobilizing capital for infrastructure projects and fostering local businesses. The intertwining of these markets with the global economy underscores the interconnected nature of financial systems worldwide. Africa's journey reflects the broader narrative of emerging economies contributing significantly to the global economic landscape. With this, we have seen the origin, birth, and expansion of stock market. Now, let us see the challenges and crises faced by the stock market over these years. The Great Depression, 1929 to 1939. In the late 1920s, the world plunged into the depths of the Great Depression, a catastrophic economic downturn that sent shockwaves through stock markets globally. The speculative excesses led to the infamous Black Tuesday in 1929. The Great Depression was triggered by the stock market crash on October 29, 1929, known as Black Tuesday. On this day, the Dow Jones Industrial Average plummeted, signaling the start of the most severe economic downturn in modern history. It plunged many businesses and investors into a prolonged struggle for recovery. This devastation led to a spike in suicides among investors who had suffered losses. The emotional toll of the market collapse was profound, highlighting the human impact of economic crisis. The Great Depression witnessed a cascade of bank failures. As businesses collapsed and people lost their jobs, many couldn't repay loans, causing a domino effect leading to the closure of many banks. The unemployment rate skyrocketed during the Great Depression, reaching approximately 25% at its peak. The widespread job losses had a profound impact on families and communities. While the Great Depression persisted for most of the 1930s, the stock market began to show signs of recovery in 1933. Many regulatory reforms emerged in its aftermath, forever altering the landscape of financial markets. In response to the economic crisis, President Franklin D. Roosevelt implemented the New Deal, a series of programs and reforms aimed at providing relief, recovery, and reform. The Securities Act of 1933 and the establishment of the SEC were key components addressing stock market issues. The Glass-Steagall Act of 1933 was enacted to prevent conflicts of interest within financial institutions. It separated commercial banking activities from investment banking. The Great Depression marked the end of the gold standard in the United States. In 1933, President Roosevelt signed an executive order prohibiting private gold ownership. Now let us embark on a journey through the turbulent waters of the 20th century's two world wars. Many stock markets around the world, including major exchanges in Europe, closed during World War I and World War II, temporary suspension of trading to prevent panic and ensure financial stability. Notable battles and turning points in the wars often had immediate impacts on stock markets. News of victories or defeats influenced investor sentiment and led to fluctuations in stock prices. Governments issued war bonds as a primary means of financing their war efforts. Citizens were encouraged to invest in these bonds, effectively lending money to the government. Wars triggered massive economic mobilization, with industries shifting their focus to wartime production. Stock markets closely reflected the fortunes of companies involved in supplying the military. Governments played an active role in stock markets during wartime. Interventions included the suspension of short selling, price controls, and increased regulatory measures to maintain stability. Currency exchange rates experienced heightened volatility during wartime. Both the world wars were followed by significant economic booms. The reconstruction efforts after the wars stimulated economic activity, leading to a surge in stock market performance. The end of World War II resulted in significant geopolitical realignments, including the establishment of the United Nations and the start of Cold War. Next, let us explore the ebb and flow of financial stability as we dissect notable financial crises of the 20th and 21st century. From the oil shocks of the 1970s to the coronavirus spread, each crisis left an indelible mark on stock markets. Let us see how these crises reshaped market dynamics, leading to innovations, regulatory changes, and a deeper understanding of risk management. The Panic of 1907, precipitated by a failed attempt to corner the market on United Copper Company shares by speculators. This crisis led to a run on banks and financial institutions. The aftermath prompted the creation of the Federal Reserve in 1913 to prevent future financial panics. We already saw the Wall Street crash of 1929, also known as Black Tuesday. The stock market lost nearly 90% of its value. Triggered by geopolitical tensions and an oil embargo, the 1970s oil crisis resulted in skyrocketing energy prices and stagflation. Stock markets experienced significant declines. On October 19, 1987, the stock market suffered its largest single-day percentage loss. While the cause remains debated, the crash prompted the introduction of circuit breakers. The savings and loan crisis, 1980s-1990s. The collapse of numerous savings and loan institutions in the United States led to a government bailout and a restructuring of financial regulations. The crisis highlighted the risks of lax oversight and contributed to the creation of the Resolution Trust Corporation. The Asian financial crisis, 1997 to 1998, currency devaluations, financial mismanagement, and speculative attacks led to a severe economic downturn in several Asian countries. Stock markets tumbled. The dot-com bubble burst, 2000 to 2002. Excessive speculation in tech stocks and the overvaluation of many internet-based companies led to the dot-com bubble burst. Many tech companies went bankrupt. Enron scandal, 2001 to 2002. The collapse of Enron, one of the largest corporate scandals in history, revealed accounting irregularities and corporate fraud. The scandal led to the dissolution of Arthur Andersen, one of the 5 largest audit and accountancy partnerships globally. The global financial crisis, 2007 to 2008, triggered by the collapse of the subprime mortgage market in the United States. The global financial crisis resulted in widespread bank failures, government bailouts, and a severe recession. Regulatory reforms, including the Dodd-Frank Act, were implemented to prevent a recurrence. Eurozone debt crisis, 2010 to 2012. Fueled by sovereign debt issues in several Eurozone countries, this crisis led to economic downturns and concerns about the viability of the euro. The crisis highlighted structural issues within the Eurozone, prompted reforms to strengthen economic governance. Finally, we have the coronavirus pandemic crisis. The spread of COVID in 2019 and 2020 triggered a massive sell-off and historic market declines. Investors grappled with the economic implications of widespread lockdowns, disruptions to supply chains, and the uncertainty regarding the duration and severity of the health crisis. Each of these crises had far-reaching consequences, influencing financial regulations, investor behavior, and the broader economic landscape. They serve as valuable lessons for understanding the complexities and risks inherent in financial markets. Now that we have explored the challenges and crises through which stock market has emerged with strength, let us unravel the technological advancements that the stock market has undergone. Let us start with the advent of electronic trading. Here we will explore how the transition from open outcry to electronic platforms revolutionized stock trading, bringing speed, efficiency, and accessibility to unprecedented levels. Let us witness the pivotal moments that mark the shift, from the first electronic exchange in the 1960s to the widespread adoption of computerized trading in the late 20th century. Nasdaq, established in 1971, marked the birth of the electronic trading revolution. It introduced computerized trading, challenging traditional open outcry systems and laying the foundation for future advancements. Dot system and decimalization, 1997 to 2001. Nasdaq's introduction of the dot system in 1997 paved the way for fully automated order execution. The subsequent shift to decimalization in 2001, moving from fractions to decimals in stock prices, increased transparency and efficiency in electronic trading. The electronic era led to the decline of open outcry trading floors. In 2006, the New York Stock Exchange, NYSE, completed its transition to a fully electronic system, symbolizing the waning influence of traditional trading methods. Algorithms executing trades at ultra-high speeds, often in microseconds, became a dominant force, shaping the landscape of electronic trading. The rise of high-frequency trading, HFT, became prominent in the 2000s. Electronic communication networks, ECNs, emerged as alternatives to traditional exchanges in the 2000s, providing direct access to market participants. Direct market access, DMA, allowed institutional investors to trade directly on electronic platforms. Regulation NMS, implemented in 2005, aimed to modernize the US stock market structure. It introduced rules such as the Order Protection Rule and the Sub-Penny Rule, fostering fair and efficient electronic trading. Algorithmic trading strategies, 2000s. Algorithms became integral to trading strategies, automating execution, optimizing trade timing, and implementing complex strategies based on market data. Algorithmic trading became a defining feature of electronic markets. Electronic trading led to market fragmentation in the 2000s, with the rise of multiple trading venues, dark pools, and alternative trading systems. While providing additional liquidity options, it raised concerns about transparency. The electronic revolution facilitated global connectivity in the 2000s. Investors could trade seamlessly across different time zones and markets, marking a significant shift towards a globally interconnected financial system. Electronic trading faced challenges, including flash crashes in the 2010s. Events like these prompted discussions on market resilience, the implementation of circuit breakers, and the need for risk controls in electronic trading systems. Now let us see a few more details on the rise of algorithmic trading. Algorithmic trading, commonly known as algo trading, originated in the 1970s when financial institutions began using computer programs to execute trades based on predefined instructions. This marked the early stages of automation in financial markets. Algo trading experienced a significant surge in the 2000s, driven by advancements in technology and increased access to high-speed internet. This period saw the widespread adoption of algorithms for executing trades at unprecedented speeds. Algo trading encompasses a diverse range of strategies, including trend following, statistical arbitrage, market making, and quantitative analysis. These algorithms use mathematical models to analyze market data and make trading decisions. High-frequency trading, HFT, emerged as a subset of algo trading, characterized by executing a large number of orders at extremely high speeds. HFT relies on complex algorithms to capitalize on market inefficiencies and price discrepancies. Algo trading contributes to market liquidity by providing a continuous flow of orders. The efficiency of algo trading algorithms helps narrow bid-ask spreads, benefiting overall market liquidity. The rise of artificial intelligence and machine learning has further enhanced algo trading. These technologies enable algorithms to adapt and learn from market conditions, refining their strategies over time. The rapid growth of algo trading has attracted regulatory scrutiny. Authorities have implemented measures to ensure market stability, prevent market manipulation, and maintain fairness in the face of increasingly sophisticated algorithms. Algo trading has been associated with instances of flash crashes, where sudden and severe price fluctuations occur in a short period. These events highlight the need for risk controls and mechanisms to prevent excessive market volatility. Many hedge funds employ quantitative strategies driven by algo trading. These quantitative hedge funds use sophisticated algorithms to analyze vast amounts of data and execute trades based on statistical models and predictive analytics. Algo trading is not limited to equities, it extends to various asset classes, including currencies, commodities, and fixed income securities. The versatility of algorithms allows for their application in diverse financial markets. The rise of algo trading has transformed the landscape of financial markets, bringing both benefits and challenges. As technology continues to advance, algo trading is likely to remain a prominent and evolving force in the world of finance. Naturally, now the question is, what is the influence of technology on market accessibility? Technology has played a pivotal role in democratizing stock market access, allowing individuals from diverse backgrounds to participate. Online trading platforms and mobile apps have provided a user-friendly interface, enabling retail investors to buy and sell stocks with ease. Technological advancements have ensured that investors have access to real-time market information. Live quotes, financial news, and market analysis are readily available, empowering investors to make informed decisions based on the latest data. The emergence of online brokerage platforms has eliminated the need for physical presence or reliance on traditional brokers. Investors can now execute trades, manage portfolios, and access research tools directly through online platforms, enhancing convenience and reducing costs. Technology has facilitated global connectivity in stock trading. Investors can seamlessly trade in international markets, diversifying their portfolios and capitalizing on opportunities worldwide. This globalization has broadened investment horizons and reduced geographical barriers. Automated trading systems, enabled by technology, execute trades based on predefined criteria without manual intervention. Algorithmic trading and robo-advisors fall under this category, providing efficient and systematic approaches to investing. ECNs have revolutionized market accessibility by providing direct access to buyers and sellers. These electronic platforms enhance liquidity, reduce spreads, and offer a transparent environment for executing trades, benefiting both institutional and retail investors. The advent of mobile trading apps has transformed the way investors engage with the stock market. These apps allow users to monitor their portfolios, execute trades, and receive real-time market updates on the go, fostering a more dynamic and responsive trading experience. Social trading platforms leverage technology to create a collaborative environment where investors can share insights, strategies, and trades. This social aspect enhances market accessibility by providing a platform for knowledge exchange and learning. Technology has introduced the concept of fractional share investing, enabling investors to buy a fraction of a share rather than a whole share. This lowers the barrier to entry, allowing individuals with limited capital to invest in high-priced stocks. The rise of cryptocurrency exchanges exemplifies the evolving landscape of market accessibility. These digital platforms allow investors to trade a variety of cryptocurrencies, offering an alternative asset class. The influence of technology on market accessibility has empowered investors, fostering a more inclusive and dynamic stock market environment. As technological innovation continues, it is likely to further reshape how individuals engage with and participate in financial markets. As we conclude this exploration of technological advancements, reflect on the profound transformation that catapulted stock trading into the 21st century. From the clatter of physical trading floors to the seamless flow of electronic transactions, technology has been the catalyst for unprecedented change. Consider the ongoing innovations, such as blockchain and artificial intelligence, poised to shape the future of finance. The digital era has not only transformed the mechanics of trading but has also redefined the very essence of how we perceive and engage with financial markets. We are nearing the end of our financial exploration. The final part of the video, diving right into recent developments and trends of the stock market. Number 1. Blockchain, the underlying technology of cryptocurrencies, has garnered attention for its potential to enhance transparency, security, and efficiency in financial transactions. The rise of cryptocurrencies, led by Bitcoin in 2009, has introduced a new asset class challenging traditional notions of currency and investment. Next development online is CBCDs. The development of central bank digital currencies by central banks are influencing the future landscape of traditional currency and financial transactions. A central bank digital currency, also called digital fiat currency or digital-based money, is a digital currency issued by a central bank, rather than by a commercial bank. Followed by artificial intelligence, AI, has been increasingly integrated into trading strategies, enabling algorithms to adapt and learn from market conditions, enhancing decision-making processes. Advanced market surveillance technologies have been implemented to detect and prevent market abuse, enhancing regulatory oversight and ensuring fair market practices. The implementation of real-time settlement systems, like T+0, is being explored to reduce settlement times and enhance the efficiency of securities transactions. Traditional market indices have evolved to include new sectors and technologies, reflecting the changing landscape of the global economy. The popularity of SPACs as an alternative route to going public has surged, offering companies a faster and less traditional IPO process. A SPAC is a publicly traded corporation with a 2-year lifespan formed with the sole purpose of effecting a merger, or combination, with a privately held business to enable it to go public. A special purpose acquisition company is also known as a blank check company. It is a shell corporation listed on a stock exchange. Next online is the integration of AR and VR technologies is being explored for enhancing the visualization and analysis of financial data and creating immersive trading experiences. Non-fungible tokens, NFTs, have made inroads into the financial world, representing unique digital assets and potential applications in areas like tokenized securities. An NFT is a data file, stored on a type of digital ledger, blockchain, which can be sold. The NFT can be associated with a particular asset, digital or physical, such as an image, art, music, etc. NFTs function like cryptographic tokens, but unlike cryptocurrencies, NFTs are not usually mutually interchangeable, so they are not fungible. A non-fungible token contains data links. Financial institutions are increasingly using alternative data sources, such as satellite imagery and social media sentiment analysis, to gain unique insights into market trends. The market has witnessed the introduction of a diverse range of investment products, including thematic ETFs, allowing investors to capitalize on specific trends or industries. The emergence of decentralized finance, DeFi, platforms leveraging blockchain. Decentralized finance, often stylized as DeFi, offers financial instruments without relying on intermediaries such as brokerages, exchanges, or banks by using smart contracts on a blockchain. It allows people to lend or borrow funds from others, speculate on price movements on assets using derivatives, trade cryptocurrencies, insure against risks, and earn interest in savings-like accounts. DeFi uses a layered architecture and highly composable building blocks. Now let us see some recent trends. First in line is rise of online communities. Online communities and forums have become influential in shaping market sentiment, providing a platform for retail investors to share insights and discuss trading strategies. Online trading communities have the power to influence market sentiment. Coordinated actions and discussions within these communities can lead to significant price movements of specific stocks. A branch of this trend is social trading platform, which allows investors to follow and replicate the trades of successful traders, fostering a collaborative and educational environment. Retail investors have shown increased interest in options trading, attracted by the potential for high returns. However, this also introduces additional risks. Also, day trading has experienced a resurgence. Retail traders, often armed with real-time data and analysis tools, engage in short-term speculation. Next is the rise of fintech companies has disrupted traditional financial services, offering innovative solutions such as robo-advisors, crowdfunding, and peer-to-peer lending. Fintech has been a driving force behind the exploration and implementation of blockchain technology and cryptocurrencies. Digital wallets are electronic platforms that allow users to store, manage, and transact with their financial assets digitally. These wallets often link to traditional bank accounts. Peer-to-peer lending involves the direct lending of money between individuals through online platforms, cutting out traditional financial intermediaries. Borrowers can access funds from individual lenders, providing an alternative to traditional banking loans. Crowdfunding is a method of raising funds for a project or venture by collecting small contributions from a large number of people, typically through online platforms. It allows entrepreneurs, artists, and other creators to access capital from a broad audience. Robo-advisors are automated, algorithm-driven platforms that provide financial advice and manage investment portfolios. These platforms use algorithms to analyze user preferences, risk tolerance, and market trends to make investment decisions. They offer a cost-effective and accessible alternative to traditional financial advisory services. ESG investing has gained traction, with investors prioritizing companies that demonstrate strong environmental, social, and governance practices. There is a rising demand for ESG investments, driven by investors seeking both financial returns and positive societal impact. The rise of retail trading, driven by accessible online platforms and commission-free trading, has reshaped market dynamics, particularly with the influence of social media on stock trends. Recent trends include an increased emphasis on financial literacy, with educational resources and initiatives aimed at empowering investors to make informed decisions. As we can see, it becomes evident that the stock market is in a state of constant evolution. From the democratization of retail trading to the transformative power of technology, these trends underscore the dynamic nature of the market, setting the stage for a future where innovation and adaptability continue to be key drivers of success. With this, we have covered the 6 topics promised at the start of the video. As we wrap up the exploration of the 6 sections promised in our initial sneak peek preview, this isn't the conclusion. Stick around, there's more to share. Congratulations on reaching this point. Your curiosity and love for learning is truly commendable. Wow! As we conclude our epic exploration, we'll recap the key points, acknowledge the ongoing evolution, and emphasize the enduring importance of stock markets in the 21st century. From the humble beginnings of stock trading in the coffeehouses of Amsterdam to the era-defining impact of modern technologies, each chapter in this saga has shaped the financial landscape in profound ways. Let's briefly rewind and appreciate the key milestones we've traversed. From the birth of the Amsterdam Stock Exchange in the 1600s, the VOC and East India Company's role in public trading, the emergence of global stock exchanges, to the tumultuous challenges faced during the Great Depression and World Wars. We looked at various other challenges and crises faced by the stock market. We delved into the technological revolution that introduced electronic trading, algorithmic strategies, and the transformative rise of cryptocurrencies and blockchain. We looked at how the current trends are like surge in retail trading, online communities, and so on. This journey was not just a historical ride, it's a testament to the resilience and adaptability of financial markets. Throughout this expedition, we acknowledge the evolution of stock markets as resilient entities. Challenges like financial crises and technological disruptions were met with adaptability, reinforcing the enduring nature of these financial institutions. As we gaze towards the future, the stock market continues to be a dynamic realm, shaped by innovation, regulatory advancements, and the collective wisdom of market participants. The very essence of the market lies in its ability to evolve, responding to the ever-changing global landscape. Before we draw the curtains, a heartfelt thank you to each one of you, our valued viewers, for embarking on this journey with us. Your curiosity and engagement have fueled our exploration, and we hope this venture has enriched your understanding of the intricate world of stocks and trading. Our exploration doesn't end here. The stock market narrative is ever evolving, and we encourage you to continue this conversation. Dive deeper into the topics that resonate with you, share your insights, and stay tuned for the unfolding chapters in the story of global finance. Don't forget to subscribe and share your thoughts in the comments. Let's continue this financial journey together. As we bid adieu to this chapter, remember that the tapestry of the stock market's history is far from complete. It is a living, breathing entity, shaped by the collective actions and aspirations of countless individuals across time. So, here's to the journey that has been and the chapters yet to be written. Thank you for joining us on this odyssey. Until we meet again, happy investing, And may your financial journey be as rewarding as the history we have explored together. Stay curious, stay invested, and stay tuned.